Yeah, it's a real big challenge at the moment because, speaking to investors, they're seeing their term deposit rates come down consistently year after year, and they're questioning what do they do with their money now to earn income. I think part of the temptation is to actually go out and buy an asset which is simply giving you what I call a high sticker price in yield. So, oh look, I can buy this asset for 5% or 7%. But the challenge there is all you're doing is you're really actually increasing risk. So given there's no free lunch, the more risk you're taking, the higher yield you'll get. But what you need to be cautious of is not to actually take too much risk that you basically burn capital. So someone who wants to roll over a term deposit, going out to something like a mortgage fund or a really high octane portfolio may give them a higher yield, but it's probably not really doing it in a defensive nature. So we think it's really important that when an investor buys an asset, they know what they're doing, what role that asset has to play, but also too importantly how it's going to behave. The way we sort of think about it at the moment is rather than simply moving further out the risk spectrum, we think you can work your portfolio harder. And what I mean by that is that first of all, let's make sure you've got all the global opportunities in your portfolio that make sense. Not simply Australian assets such as hybrids, but look beyond those, because there we can actually find value and diversify the portfolio as well. And second of all, I think active management's really key. There's an increasing trend towards passive ETFs, but what you're effectively doing is you're buying typically the most indebted companies in a debt index. What you're not doing is allowing yourself the opportunity to actually avoid the losers and pick the winners. So we think using the full opportunity set, being active, but also to be careful in terms of how much risk you're taking, particularly this point of the cycle. I think the temptation really is to actually try and back solve to say, well, I used to have 5% income from a particular asset and now that's dropped to say 1.5 in a term deposit. I need to replace that. But in that vein, I'd be cautious. Well, first of all, hybrids are an important part of the investor portfolio, but it's a natural limit to how much you can hold of that, or you should hold. We hold it in our absolute return income fund. That's around 9%. What we do is we diversify around that and we hedge and manage some of that risk. But importantly, when you're looking at an asset to buy, you need to think about what you're getting paid for. So if I've got a mortgage rate of 3.5 and a credit card rate of 12, and someone's offering me 7, that should give you a good idea of how much risk you're taking. It's not really bricks and mortar securitized lending, and it's sort of closer to actually what you would in unsecured credit card lending. So I think there's no free lunch, and hence you want to make sure that diversified portfolios are important. Use hybrids, but be cautious and understand how they behave, particularly in risk-off events. Be cautious of things like mortgage funds. If they're offering you 5 to 7% for a mortgage fund, and typically you can fund at 3.5, why would someone actually borrow it at 5 or 7% when they can borrow at 3.5? So you just need to be cautious of that. And I think you need to also be careful about structured products. Anything that actually tries to manufacture yield would, for me, starts to ring alarm bells. I think it's really important at this point of the cycle that if you're looking to allocate to income products, and there's a wide range out there, that you really make sure that they are defensive in nature when you're using them in the defensive portion of your portfolio.